We are back in the black hole of real estate and staying on point to give some opinions of what I might do in certain situations. Today we're going to talk about what I would do if I was making a purchase using an FHA loan. This is your host, Ron Wysakarski, for the black hole of real estate. And an FHA loan is something that's been in place about 100 years, and it was designed to help home buyers obtain a mortgage on a house with less than 20% down. So a lot of times you'll hear them say, hey, it's a first-time home buyer's loan. Well, it is. But it's also a loan that anybody can use if they don't have one in place. And the advantages of it are the low down payment of 3.5%. There's only two loan types, basically, that are lower than that. There's VA, which is 0% down in a lot of cases, or a USDA loan, a rural loan with no money down. And occasionally you'll see a 97% finance deal with 3% down. It's a conventional loan where they blend in the mortgage insurance. But beyond that, it's the FHA loan, which is super popular. It doesn't necessarily have a baseline credit score, so you could be less than perfect and qualify. It offers a little bit more room as far as the guidelines, so what your debt-to-income ratio could be. And for a lot of buyers, it's really a good program because it's less money out of pocket at closing. And there's a provision where the seller can help pay some or all of the closing costs. Now, in most cases, a 3% seller concession is allowable. It can climb as high, as 6% with about 10% down. And there's an extreme case with an even higher amount, but that doesn't usually work out too well. I think what we're finding in most FHA loans that they're going to do it, they'll use a fixed amount of money to go towards closing costs and prepaid items, or they'll use a percent, and many times it's 3%. So if you were looking at a home for $300,000 and the concession was 3%, it'd be $9,000. So the $300,000 purchase price, and let's just subtract the $9,000 concessions to make a $291,000 purchase price. That's what it feels like for the seller, because it's full price $300,000, let's say, but $9,000 going back at closing, it's really $291,000, so it's less money to them. Now, keep in mind that the appraisal of the home has to come in at the higher number. It has to come in at the $300,000 number, not the $291,000. So let's just suppose that the appraisal comes in at $295,000. And the buyer says, well, geez, hey, the appraisal only came in at $295,000. You've got to drop the price $5,000 because that's what it appraised at. And the seller's response could very well be, not a problem, but we're going to reduce your closing costs of $9,000 down to $4,000 because I agreed to sell it to you for that $291,000 net, and that's where it would be. Now, there are cases where the buyers find money and they can actually pay the difference on that down payment to get the home. There are times where the seller just says, I really want to sell. Don't worry about the $5,000. I'll just take the $5,000 off because I don't want to go back on the market. Or sometimes they find a way to chop it up and split it. So all of these are ways that it can work. And when you think about the FHA loan, the appraisal is going to be a little more in-depth than a mortgage with, let's say, a conventional loan. So think of it this way. When you do home inspections, there is a 4-point inspection that's available. It's plumbing, heating, HVAC, electrical, and then your roof. And that is a lot of what goes into an FHA appraisal, because they're looking at those items as well as the sales comparables and anything about the house that would determine values, because it's collateral. So if the appraisal is looking at, in essence, a 4-point inspection and the area sales comps, that's going to really help them to give their opinion of value, which is what an appraisal is. And this just in, if I sent 3 appraisers out to appraise a house and I didn't tell any of them what the contract price was, I think it was highly likely they come back with 3 different numbers. Now, it might be slightly different or very different, but without the guidance of a contract price, I think that you'll find differing values, because an appraisal is an opinion of value. It's a pretty big opinion when the bank is loading out pretty much $300,000. They want to make sure that the collateral, the house, is actually worth that amount of money. So that's where that comes from. So if you're purchasing with FHA,
It's 3.5% down. You'll have closing costs, but you could ask the seller to pay for that. So in this scenario, 3.5% of $300,000 is $10,500. You could very well be in a home for $10,000 or thereabouts, $10,500, and that's a really good option for a lot of people. You could also use some of the concessions to buy down the interest rate, to have a lower monthly payment in the first couple of years. That's also a possibility. We've talked about 2-1 buy downs extensively on this podcast. But it's taking what it's doing is taking some of the monthly payment in the first year and the second year and making it part of the closing costs that the buyer or seller can pay for, so the payments are lower. It can help the buyer qualify on that lower payment in the first year or two. That might help them out. Certainly would help them if there's any repairs or if they're just new with the home, they want to decorate it and do things with it. So it's another thing for them to be able to do should they want to have a lower payment in the beginning. And with interest rates a bit high right now for most people's liking, if rates go down in the next couple of years, they could absolutely refinance and might get a lower payment ongoing. And that could be a really big win for so many people buying right now. And when you're talking about the barrier to entry into a market, the difference between 3.5% and 5% down or 10% down, it's pretty big. And it could very well help some people get a home that might otherwise not qualify or have the cash to actually make the purchase. Now, when you put less than 20% down, you're going to have mortgage insurance on it. And don't make any mistake about it. Homeowners insurance covers the home. The mortgage insurance, the buyer pays for, and it's to help the bank recover any lost money if they have to foreclose on you. So it's really for the bank. Think of it this way. If you bought it at $300 and you put, let's just say $10,000 down, you'd owe $290. And if you had to sell it the next year, you may not get all $290 back to pay off the closing costs, the mortgage amount, because the closing costs and commissions might be more than that. So there is this opportunity where a seller could be short at closing. Now, what if it's a monumental gap of $30,000 or $40,000, or even worse? That mortgage insurance could kick in if the bank had to foreclose if the buyer couldn't sell. Now, the good news is most people that have bought in the last 5 years have seen a significant amount of equity increase. So even if they made closing costs a part of their mortgage, most people still have enough equity to sell it, maybe break even, but not have to write a check at closing. Now, speaking of that mortgage insurance, and this is something to think about, it's for life on an FHA loan. So if you take out a $290,000 loan, and let's say you pay half of it off, you're down to $150,000, the mortgage insurance is still there, even though you've got more than 20% equity. It didn't used to be that way, but back in, 2010, and that time when they were changing laws around, banking laws, because the way lending was working, there were some predatory actions in it. They made the mortgage insurance for life. So now what we find is you get equity, whether you're sweat equity, you're making an addition, doing home improvements, you're still paying this mortgage insurance, which might be $100, $200, $300 a month. That is unavoidable for the term of a loan. It's a reason why people refinance. For certain, they can go back in and get the prevailing interest rate, but get rid of the mortgage insurance. Once they can demonstrate more than 20% equity, the bank will require you to apply for it, which really is a thing online that you do, and then you pay them money, like $600 or so for an appraisal, and it does vary. But if you pay them for an appraisal and it comes back and shows that you have enough equity, you're good. If you're a little bit short, then you can write a check and say, okay, well, look, now we're at this line over here. We want to get it off. And that works if it's conventional. And it used to work on FHA, but now they just said, hey, guess what? It's just for life. So I gave you that example of how to get rid of the MI, mortgage insurance. But if it doesn't work for FHA, why did I mention it to you? The reason is because a conventional loan allows you to get rid of the mortgage insurance when you get, let's say, 75%, 78%, 80% loan to value, somewhere in there. And when you have that in there, if you had a $300,000 house and you owed less than $240,000 on it, then you can apply to the bank to get it removed. That's a conventional loan. So you're still wondering, Ron, why did you bring this up? Well, pretty simple. Let's suppose for a minute that the buyer's putting down 3.5%, $10,500. Well, what if they can do another 1.5% to make it 5% down? Well, now they can use a conventional loan. It would cost them a $15,000 payment. They can still ask for the 3% closing cost back. So what we run into is for about $4,500 more in down payment, at some point, you can make the mortgage insurance go bye-bye. And that's why I bring it up. So there is a way with conventional loans to get rid of the mortgage insurance, but with FHA, it's for life. Now, how would you make this decision on which way to go with it? I would say if your time horizon is such that you're going to be in the home for a few years like a starter home, and then you're going to buy a different home, and you're going to sell this home, I would take the lower down payment. It's really simple. You're not going to get to the point where there's enough equity to save enough money to make it worth your while if you're going to move in 2, 3, 4 years. But if you were wealth building and you were going to keep this property, and let's just say the whole 30 years, but maybe somewhere along the line, move out while you're buying a different home, but keep it as a rental, then I might want to save that $100, $200, $300 a month, because over 25 or 30 years, that couple $1,000s a year would really add up and put more money in your pocket along the way for retirement, investments, or whatever you want that to be. So to recap, an FHA loan, 3.5% down. You can ask the seller to pay closing costs. It's a great way to go. The mortgage insurance, it's for life. If you can stretch and put a little bit more money down, 5% down, you can go conventional. And at some point, when you're at 20% equity or better, then you have a chance to make the mortgage insurance go away. Now keep in mind, most loan programs have something with the lenders right now where they can lower the interest rate with no lender fees, but you'll have some closing cost fees. If it happens within the first 3 or 5 years, I would explore all these possibilities, and then you can make a really, really good decision. So that's what I wanted to tell you today about I would do if I was purchasing with an FHA loan, and the reasons why I might choose to do it or not to do it. This is your host, Ron Wojciechowski, for the Black Hole of Real Estate.